I'm John Hanna for CDTV.net in New York, and we have Dirk Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. Hey, Dirk.
Hey John, how's it going?
It's snowing out here in New York City. How about yourself? How about your location?
Well, it's just above freezing here, semi-sunny and whatnot. I'm sure it won't fall back into the icebox tonight, though.
It's stopped though. It's snowing already, by the way. Just wanted to give you an update because it was snowing earlier. But it was freezing yesterday, so like you guys, we're gonna be in the icebox as well. So that's the thing. Can't wait for the summertime, huh?
Yep, and it's kind of odd. It's been colder around here than it has been up in northern Canada and Greenland, where it's been exceptionally warm.
Yeah, yeah.
Totally weird weather.
Okay, now let's try to
So,
explain the housing market. What do you have so far for the Case-Schiller index?
well, we had the Case-Schiller index come out today, and yet more bad news on the housing pricing front. The Case-Shiller index is the gold standard of housing price indexes. The drawback is that the data is a little bit on the tardy side, so we're looking at November numbers, and actually those November numbers are 3-month uh, moving average. So we actually have some data from September and October in here. So but the picture is not a pretty one. On a month-to-month basis, the 10-city composite was down 37 basis points from October, and the 20-city composite was down 54 basis points, or over a half a percent. On a year-over-year basis, both indexes are now down 0.43% for the 10-city and 1.61% on a year-over-year basis. Again, all these numbers are the seasonally adjusted numbers. A lot of the press, when they report this data, they use the unadjusted numbers, but there is a seasonal pattern to housing prices, so you really should be looking at the seasonally adjusted numbers. From the peak during the housing bubble, which was April in 2006, the 10-city composite is down just about 31%, 30.99, and the 20-city composite is down 30.91%. For the month, there were 3 cities that saw increases in their prices and 16 down, with Las Vegas unchanged. We had 7 cities which saw month-to-month declines of over 1%. Leading the way on the downside were Detroit, down 2.25%, Atlanta down 1.69%, Chicago down 1.64%, Minnesota down 1.37%. The only cities increasing on a month-to-month basis were San Diego up 52 basis points, Washington, D.C. up 51, and Charlotte, North Carolina up just 7 basis points, which effectively is unchanged. On a year-over-year basis, again, we've got 16 cities down, with just 4 up. The 4 that are up are the 3 California cities, plus Washington, D.C. Washington, D.C. has the biggest increase at 3.46%, followed by San Diego at 2.56%, and LA at 2.07%. San Francisco rounds out the list with an increase of 37 basis points, which is just fractionally above zero. The worst year-over-year declines are Atlanta down 7.91%, followed by Chicago 7.61%, Detroit 7.11%, Portland, Oregon down almost 7%, 6.97%, and Phoenix down 6.42%. So we're seeing big year-over-year declines in just about every corner of the country there. From the peak, all 20 cities are down pretty significantly. You've got 5 cities that are down over 40%. Las Vegas continues to be the absolute worst, down 57.78%. And Phoenix is close on its heel, is down 54.79%. That city just isn't rising from the ashes there, especially with things headed back down again. Detroit down 47.15%. It's not like there was ever really a housing price bubble in Detroit. It just was low and then fell apart from there. And then the two Florida cities tracked, Miami down 48.85% and Tampa down 44.08%, round out the top five decliners. There aren't a lot of cities that are down. Only two of them are down less than 10% from the peaks. Those are Dallas down 7.03 and Charlotte down 8.34%. Denver is in third place with a 10.3% decline. This is pretty bad news. I mean, we for a while were able to sort of stabilize housing prices and get them to just start to edge up a little bit, but we're doing that with enormous amounts of federal support for the housing market, not just the ongoing mortgage interest deduction, which is a massive subsidy for homeowners, but that's been in place forever. But we had special programs like the tax buying, the new home buyer tax credit of up to $8,000, which helped stabilize prices for a while. The Federal Reserve buying up massive amounts of mortgage-backed securities to hold down mortgage rates in an attempt to support the home prices. But those programs are pretty well over, and now we're seeing the second leg down in housing prices. So far, the 20-city composite is still a little bit above its previous low, but in a couple of months, we're probably going to take that out. We still have pretty high inventories relative to the sales rate for existing homes, although it's well down off the record 12 and a half months that we saw back in June, but it's still higher than normal, and that indicates more downward pressure on housing prices. The good news is we're probably not going to see another 30% decline like we saw in the first decline, just because housing prices are a lot more reasonable relative to both rents and incomes than they were back in 2006 at the peak of the bubble. So, we're probably looking at about 5% more declines based on the 20-city composite. From here, that's not as devastating as the 30%, but it's enough to be very worrisome, because every time you see the house prices decline, it means that more and more people are becoming underwater on their mortgages, and also those that are underwater are further underwater. And it's a necessary but not sufficient condition for a foreclosure for the value of the house to be worth less than the value of the mortgage. Otherwise, even if your cash flow totally dried up and you couldn't afford the home, you'd still be better off selling the house and letting it go into foreclosure. No, it's not a bright dividing line where if you're all of a sudden your house is worth $1 less than the value of the mortgage, where people immediately just mail in the keys. The magnitude of how far you are underwater, means a great deal, because there are lots of sort of non-economic reasons for somebody to hold on to a house. There's little markings where your kids have grown over the years, the fact that you don't want to pull your kids out of the schools that they're going to, attachments to the neighborhoods and your friendships with your neighbors. All those things can easily outweigh the pure financial saying, well, I could sell this house for more than it's quote unquote worth simply by not paying my mortgage and letting the bank take over. So if you're underwater by $1,000, you're probably not going to let the house go into foreclosure. If you're underwater by 50,000 or 100,000, yeah, then that economic consideration can easily outweigh all those non-economic considerations. So the fact that home prices continue to fall is going to make the foreclosure crisis worse. And also, keep in mind that for the vast majority of Americans, housing equity is, or at least was, their principal store of wealth, much more so than, say, the stock market, where the wealth tends to be extremely concentrated in just a few hands. I mean, nobody has $100 million worth of housing equity, but there are quite a few people that have $100 million worth of of stock market portfolios or ownership interests in the companies that they run, that sort of thing. So it's a much more diffuse storage of wealth than is the stock market. And that with that loss of wealth, people then have to try and make up for that by savings more, because it's wealth that was actually sort of had purpose in mind, financing somebody's retirement, putting the kids through college. If you're still planning on sending your kids to college and you can't draw out the equity in your house like you plan to, well, then you've got to spend less and save more. And that process is retarding the recovery. It also means that we're farther away from the point where we have to start building more houses. And building houses introduces a lot of economic activity into the economy. You need the lumber, the wallboard, the roofers. You need to hire the people to put it all together. And then those people have money in their pockets and they go out and spend, and starts that virtuous cycle. And historically, that has been the primary locomotive that gets us out of a recession. That locomotive continues to be derailed. So it's actually rather remarkable that the economy is doing as well as it is, given the lack of this historic locomotive in getting the economy going again. So this was a disappointing report, and that might be a bit of a misnomer in that I think everybody was expecting more housing price weakness, but it definitely is discouraging for the overall economy. We simply are not out of the woods yet on the housing situation. And after all, the housing situation really was the cause of this downturn. I wish I had happier news, but the data is not providing it when it comes to the housing market.
That's Dirk Van Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio, and I'm John Hanna for CDTV.net in New York.